You're at your desk, market tape humming, green numbers reflecting on your screen like a small carnival. 3 winners in a row, P&L up, chest warm, and the next trade looks obvious. That's the micro scene that ends careers quietly, and we're going to unpack it so you have rules to stop the slow leak. Winning streaks create a subtle pressure you don't notice until size has crept, correlation piled on, and your equity curve looks jagged for reasons that feel like skill but are mostly chance. The stakes are simple. If you let reward sensitivity rewire your sizing, your long-term expectancy can erode even while you feel good in the moment. Size creep means the gradual, unplanned increase in position size or net exposure driven by recent wins, cross-instrument bets, or emotional permission rather than by your documented setup parameters. That's it. Call it what it is and stop euphemisms. Psychologically, streaks tap into intermittent reinforcement and recency bias. You get rewarded, dopamine spikes, you reinterpret noise as signal, and your internal risk tolerance ratchets up without any fresh edge. Mechanistically, this plays out as 3 behaviors. First, incremental size increases, maybe a 10 to 30% bump per good trade, compound over a series of wins. Second, correlation blindness, adding exposure in correlated symbols or layering correlated ETFs without checking net exposure. Third, rule drift, ignoring your checklist when the next opportunity feels right. Those moves don't feel reckless at the moment. They feel like optimization. That's the trick. If you can name the mechanism, you can design a system to interrupt it. Here's the playbook. Concrete and testable, so you can deploy immediately. Baseline size is your documented R size on A setups. Call that 1R for planning. Off-plan impulses, trades you take without a pre-approved A setup, are capped at 0.25R. If you win 3 consecutive trades, then your next 3 trades default to 75% of baseline size, unless you pass a written exception protocol. If an exception triggers, you must have 2 5-minute closes past VWAP with rising cumulative delta and session volume 1.2x baseline, or a trendline break plus clean retest plus higher low on 5-minute, or cross-asset confirmation such as ES plus sector breadth greater than 70% advancing. Otherwise, the cap remains. If you add a correlated instrument, then run a quick correlation check and ensure net exposure to that sector does not exceed 1.2 times your single instrument maximum. Document the check. Timers and gates stop emotional decisions cold. After any streak of 3 wins, insert a 30-minute cooldown before increasing size, or wait for 2 5-minute closes past VWAP with rising cumulative delta. After a rule break, size exceedance, off-plan entry, or failed stop, initiate a mandatory 60-minute review and a 24-hour reduction of baseline size to 50% until you've replayed the session and tagged the trades. Pre-trade branches belong on paper before you click. Write best, worst, and most likely outcomes for that trade. Quantify the worst-case R you're willing to risk and set the kill switch. If price moves X% against you or your correlation basket widens beyond your limit, kill the position. Practice concrete confirmation language. Don't accept fuzzy, looks good terms. Require 2 5-minute closes past VWAP with rising cumulative delta for momentum continuation, or 2 consecutive range breaks with session volume 1.2 times baseline for breakout plays, or trendline break plus retest plus HL on 5-minute for structure plays. If your rule requires volume, use session volume numbers. If it requires breadth, use a percentage. That way, the market has to physically meet your terms before your size does. Size rules must be explicit and non-negotiable. Baseline size on A setups, 0.25 R max for off-plan impulses, automatic 75% cap after 3 wins for 3 trades, absolute portfolio max exposure set as a percentage of capital and not negotiable intraday. Use a simple visual, a size dial on your execution screen, or a sticky note that sets max contracts for that instrument, updated only after a documented decision process. If X, then Y rules keep emotion out of the cockpit. If you hit a 3-win streak, then reduce size for the next 3 trades. If you take an off-plan trade, then cap to 0.25 R and start a log entry with tags #offplan and #sizebreak. Log it. Your journal needs tags that map to behavior. #asetup, #falsepause, #offplan, #sizebreak, #tilt. Those tags let you run weekly audits for patterns instead of relying on memory. A simple weekly audit drill. Over 7 sessions, flag every trade with a tag. Then count the ratio of #asetup to #offplan trades and the win rate per tag. If off-plan trades win less than A setups by more than 10% or consume more than 20% of total risk, you tighten caps. Drills accelerate habituation. Do a 7-session feed audit where you mute non-essential alerts, run a silent platform block for 2 hours with a single controlled alarm permitted, and perform blind entry pre-commit exercises where you write the entry, size, stop, and exit before opening the chart. These drills rewire the action bias and reduce the novelty chase that fuels streak-driven size creep. Let me give you a time-stamped example so this isn't abstract. NQ, 10:17 a.m., midweek, 2 5-minute closes above VWAP with rising cumulative delta. Session volume 1.35 baseline. I took the A setup, held base size for 0.5 R in 6 minutes, and then trailed to prior 5-minute HL when volume contracted. The trade returned plus 0.5 R and validated the plan. Contrast that with a messy example I lived. Last month, after 3 winners, I felt bulletproof. The screen had that smeared green of a late rally, my palms were warm, and I scaled an extra 40% into what I called a sure thing, and then gifted 1.3 R on a correlated fade because I'd ignored correlation and the stop logic. Small, avoidable slip. Those 2 sketches show the trade-off clearly. You can miss the first fast 0.5 R by staying conservative, or you can donate 2 R to noise by letting size run unchecked. Personally, I'd rather miss the first 0.5 R than donate 2 R to noise. Now anticipate a counterexample. Sometimes the market gaps or runs a rare high-velocity move that fits none of your neat rules, yet offers a real edge. And you will need an exception protocol. Document exceptions in advance. Define the exact multi-factor criteria that allow you to override a cap, such as cross-asset alignment, session volume greater than 2 times baseline, and market breadth greater than 80%. And limit exceptions to a reasonable number per month. A worked drill for exceptions. Simulate 3 rapid run events in replay mode. Practice the exception checklist and count how often the exception rules would have saved you versus how often they would have encouraged reckless sizing. Implementation is where most plans die, so simplify execution. Implement the size cap as a hard rule in your execution template, or record it in a visible place on your screen. Set automated alerts for reaching 3 wins in a session, and program a timer that locks the size dial for 30 minutes after a streak. If you can't automate, use physical devices, a phone timer you must stop to change size, or a separate trading account where off-plan trades must be less than or equal to 0.25R by rule. Protect the edge with mutable but accountable books. Require 2 independent confirmations for any size increase. Documented A setup plus 2 5-minute closes past VWAP with rising cumulative delta, or the other concrete criteria we discussed, before you scale beyond baseline. Behavioral reinforcement matters. Reward compliance as much as you record P&L. Use process scores, rule compliance percentage, whitelisted alert hit rate, off-plan incidents, and make a quarterly goal to increase compliance by a fixed %. Keep your identity separate from single trades. Name the bias when it hits, call it streak euphoria, and use a pre-committed self-talk script. I trade the plan, not the feeling. Wait, breathe, check size. Practice that script in the drills until it's reflexive. The record-keeping step must be fast and brutal. After every session, tag trades, note which rule applied, and quantify the impact of any size deviation on realized variance. If you broke a rule, write 1 sentence explaining why and what change will prevent it. This is low friction but high value. Over weeks, the tags reveal whether streaks create systematic risk creep or whether your wins genuinely come from repeatable edges. You'll notice patterns. Maybe your win rate on A setups is steady, but your variance increases on off-plan trades. That tells you where risk is leaking. Expect trade-offs and accept them. The core trade-off is speed versus sustainability. Bigger size now can amplify short-term gains, but also accelerate ruin if the environment shifts. The practical decision is not heroic. Trade conservatively enough to survive and ruthlessly enough to learn. A few concrete if-then rules to embed immediately. If you win 3 consecutive trades, then cap to 75% baseline size for 3 trades or 30 minutes, whichever is longer. If you take an off-plan trade, then cap to 0.25R and tag #offplan. If you break size rules, then take a 60-minute review and reduce baseline size to 50% for the next 24 hours. Run the weekly and monthly audits like you run readouts on any system. Compare win rates, variance, and the distribution of returns across tags. One harmless imperfection: I sometimes write the wrong tag by reflex and have to correct it later. Annoying, yes, but those corrections are part of a living process. On the emotional side, build micro-habits that arrest the dopamine loop. 3 deep breaths before placing any increase-sized order. A 10-second pause to read your pre-trade branches aloud. And a physical note on your desk that reads, "Play the whole board," reminding you to think about net exposure, not just the one market flashing green. If you're trading with others, add accountability. A weekly peer review where you disclose tag ratios and rule breaks can cut denial faster than any solo therapy. Finally, a pragmatic wrap. Practice these rules in replay and small size until they become default behavior. Treat the drills as deliberate practice, not optional hygiene. You'll live with trade-offs. Sometimes you miss a rapid move, sometimes you capture extended trends. But this framework can reduce stealth risk that masquerades as skill. Close the session by committing to one small change today. Pick one if-then rule from this script, implement it, and run the 7-session audit. Repeat the cycle, and in 3 months, you'll have objective evidence whether the guardrail helps your expectation and controls equity volatility.